Good afternoon, good morning, and good evening to all of the Smoking Barrel Nation. I'm Rustin Edwards, based in Geneva, with my croaky colleague, Matt Stanley, in
Yeah,
Dubai.
man down, medic. No, look, we don't do illness on the smoking barrel. But yeah, I apologise in advance, viewers, if I sound rubbish because I feel a bit rubbish. And it's not an Arsenal injury. I'm not choking on anything. I just caught my daughter's infection. All right, so that's it. Enough. But I'm feeling good, so it's fine. It's
We
fine.
all know it was because you were screaming at the TV, watching the footy the other day. Come on.
It did start around 7:30 Dubai time on Sunday. Yes, Heineken helps though, so that's okay.
It's good lubrication. Keep the throat muscles relaxed. That's what.
Exactly, mate. I should tell my wife that as well. Actually, I don't. I'm going to say that. Sorry, love. Anyway, smoking barrel. Hello, everyone. Hello.
Hey, yeah, so here we got a crude oil market, $76.42 on Brent this morning.
Yeah,
WTI, 72.73. A lot of things floating around. A lot of bearishness. It feels that people are still not really buying into the fact that the market is going to be higher in the second half of the year so far.
yeah. I mean, you're certainly coming into that part of the year where those forecasts have got to ring true. I would argue that needs to be addressed. I mean, I was having this conversation with someone the other day. OPEC the OPEC group, OPEC Plus have done a great job since the pandemic in terms of managing markets, managing expectations, anticipating what markets may or may not do. I mean, what did His Excellency Prince Abdulaziz says? Second guess OPEC at your peril, or something frightful like that. That had you running around the back of the sofa. But I mean, arguably OPEC took the bull by the horns, literally, and they anticipated that things may not come in as forecast, cut production, caused flat price to rally, and I would argue that they're probably happy where it settled, sort of mid-70s. Do we get back up to the 80, 90? I'm not so sure, but China is disappointed in terms of, what we're 10th of May today, and Chinese international travel isn't there. Domestic travel is good, but international's not there, so that's disappointed to the downside. But yeah, you say things now.
Yeah, well, I mean, you go look at China, disappointing. I mean, we've got the PMI data that's come out that shows that the manufacturing sector contracted. That I think surprised a lot of people, or continues to surprise a lot of people, because that is the driver of economic growth and consumption inside China. You look at the import-export numbers that came out yesterday. Both of them trending lower. Imports were down over 7%. Exports were up over 8%. But a lot of that was also driven by the amount of petroleum that they've been exporting into the market. So there is a case that their internal demand is just not there to support their economy as much as people are hoping that's what comes out, because it is a forecast. It's not an actual yet. And here we are in mid-May, and at $76 crude, we're a far cry from 100 that a lot of the banks were forecasting would be at the second half of the second half of the year.
Yeah.
So it is going to require a massive uptick in demand from China, because that's what everybody was betting on. China would be China and Asia demand would be the driving force behind any rally, and it just hasn't materialized yet. Yes, India is probably the one shining star in the whole Eastern market, but again, they're not an export-driven market; they're just a consumer market.
Yeah, and also they've benefited as well from buying Russian oil. So
and so is China, for that matter.
Yeah, it has. But I mean, if you're looking at, say, I want to say blatant, but Reliance, for example, buying a lot of Urals, diesel margins, diesel refining margins, diesel cracks have come under a lot of pressure recently. But when you've got cheap feedstock compared to the rest of the world, those refining margins have just increased. So yeah, I think we started the year, season one of your favorite energy podcast. At the start of the year, we were talking about China and the market's complacency vis-a-vis China, and how much focus is put on China. And we both agreed, for a change, that the market needs to look beyond that. That it's not it's not the growing tiger economy that it once was. It's still growing, but it's a developed economy, and it's got some serious headwinds. You know, look at the real estate sector; they're still under enormous pressure. So yeah, I think that the Chinese argument is a little weak, but you know, Reuters loves to blame something, so why not blame China?
Well, I mean, and when you look at refining margins in general, across Asian refining margins now in the single digits, low single digits, which is actually prompting some refiners to contemplate run cuts. I believe it was a Korean refinery was saying that they're going to come out and turn around and probably cut runs by 10%. And then you
Yeah,
had Thai refineries also saying they were going to start cutting runs just to limit the amount of product they're making. So it tells you that their own internal demand is not that good, and export demand is probably not that good. I mean, if you look at distillate, which is the largest industrial fuel in the world, you've got contango in the distillate markets,
right.
and
Still,
still, I mean, and contango out to November, so it's kind of one of these things that if distillate's in contango, that tells you there's no shortfall. Uh,
yeah,
Now it's not a super steep contango, it's not full carry, but nevertheless, it's a carry.
yeah. I mean, look, it's again, it's this story of two halves, because one of the proxies we look at in the Middle East for economic growth or economic sentiment is air traffic through DXB, through Dubai International Airport, which is 96% of COVID levels. Now, I'm pretty sure eventually someone's going to get bored of economically comparing where we were pre-pandemic, because it's 3 years ago now. I mean, it doesn't seem that long ago, I know, but attitudes have changed, appetite has changed. We live in an expensive borrowing world now compared to what it has been. I mean, not compared to when my mum and dad were first buying a house, but interest rates. We're used to a low interest rate environment. That has affected how much people are spending, the inflation argument, the cost of living crisis. But air footfall, through DXP is extraordinarily good, and I think that is a fair reflection on a proxy basis for how
But
people are spending money.
But is that a change in also the dynamics of the world economy? Because you've got an influx of business that has grown Dubai with all the Russian relocations that have happened, all the Russian companies that have changed position there. So you do have a change in the business structure around Dubai, which should increase air traffic flow because people who are now flying into Dubai because I've got to have a meeting with so and so flying out of Dubai. So
Yeah,
Dubai may have shifted. That just means you've taken business from other places. Like for instance, Geneva used to be a big commodities trading hub, but you go to the Geneva airport and it's almost a ghost town now.
really.
It used to be
Yeah,
a
look.
uh,
Yeah, look. Yeah, you can. Yeah, I agree with you. I mean, look, it's not new business per se, on a global basis. But Dubai has positioned itself. I mean, there was another Bloomberg article the weekend, and obviously the Russian story was one that emerged last year, very quickly as well. But the article at the weekend said a lot of the traders from London are relocating to
oh,
Dubai.
sure. Oh yeah, in low tax environment. Why not?
Yeah, well, that's something that I mentioned on the radio this morning to the guys. Was I'd argue we're perhaps close to a pivot point on that, because you can't have every company in the world bringing over all their staff from, say, London or Paris or Geneva, wherever it might be. There has to be a point where, okay, that's enough. There is, I've been here for over 10 years now. When I first moved here, you were scrambling around to find traders to go out with or to do business with. And now you bump into people in Spinneys, which is one of the supermarkets here. So it's changed very, very quickly. But Dubai is a winner from, if you want to call the last year what's happened. Dubai has emerged strong.
Yep, I would say that's probably a very accurate assessment. Because Dubai, you just see it in all the value of goods going into Dubai. But we're not here to talk about real estate. We're here to talk about oil.
That's right.
Although the demand for real estate does impact the demand for oil in one way or another, just as the manufacturing fuels. But when you look at the whole general economic condition right now, I think things are still on a shaky foot. That's probably also impacting oil prices today, as people don't have the confidence in the forward projections of global economic growth to have a higher price of flat price oil. And so that's why I think Brent has been under pressure. I mean, you look at recently, you have SBB up in Sweden, which is one of the largest real estate developers. Here we are going back to housing again, but they've been downgraded to junk because of the collapse in the housing prices in Sweden, because people just aren't buying homes anymore and they've become more expensive to buy.
Yeah.
And when you look at the construction costs around the world, I mean, yes, when you go from 0% financing to 5% financing, it does put a economic drag. I mean, horrors of horrors, there was a UK bank advertising, zero interest or zero down payment loans again, which,
Right.
if we all remember 2008, 2007, that's not a sustainable strategy if you're a bank.
No, no, I agree with you. I mean, it's actually been I know obviously we're all about focused on energy and shipping, etc. But it's been a relatively quiet week, compared to what we've had over the last few weeks, with the US banking crisis. I mean, that's gone very quiet. Credit Suisse, UBS, that's gone very quiet. Yeah, I mean, interest. I just wonder if the markets are preparing themselves for a shift in momentum, because all people were talking about, and it started to calm down after the Fed meeting last week. Then you had non-farm payrolls, which were good again, defying all expectations, every economist's expectation. I wonder if the market is readjusting to the fact that it's no longer banked on or baked in the cake that
Well, I think
interest rates will continue to go up.
I think that's the thing that I think people need to come to grips with, is that you have even up to the Fed announcement, you had a lot of people talking about, oh, the Fed is going to have to pivot. They're going to have to pivot in Q3, Q4. The world needs lower interest rates, which, that to me is like the crack addict on the corner looking for his next hit, because, they can't
Wow.
see the function in a higher interest rate environment.
Yeah.
And being at zero interest rates, is that really necessarily a healthy place to be from a global economy? Probably not. You probably do need to have a higher interest rate, because it does shake out a lot of marginal business from the world.
Yeah.
And I think as we got today, we've got CPI data out of the United States coming up, and that's going to be interesting to see how the market takes that into scope.
Yeah.
On top of that, with the strong non-farm payrolls, it should point to does the Fed even increase interest rates? Because I think it was Williams, Fed President Williams, was speaking last night, and he basically pointed out that okay, interest rates are not going to be lowered, and we may actually have to go higher, because things still aren't up to snuff yet. We still have over 5% inflation. We need to get it down to 2%, and to do that, we have to keep gradually increasing interest rates.
Mm.
So I don't see I don't see an end to that just yet.
Yeah, no, I agree. I don't know. I would argue that I think that the 2% inflation target needs to be adjusted more than it does to justify higher interest rates in an environment where, as you said, UK banks looking at 100% loan to value now, and housing. There has to be an element of stimulus, regardless of buyback programs or whatever fiscal policies they're going to put in place. I would argue that the interest rate hike cycle needs to come to an end. Otherwise, it's just going to cause collapses. Look, non-farm payrolls last week, they added 253,000 jobs in April. It's always the first week of the month that we see, on the first Friday of the month, that we see non-farm payrolls. It continues to outperform. What do they want? Do they want economic peril for the population? I don't think they do. I just think they need to adjust policy a lot.
It's not economic peril, though. It's the fact that inside that non-farm payrolls data is wage increase. How much did wages go up? And wages continue to go up. So if wages are going up, which is not a bad thing if you're a worker, we all like higher salaries, higher paychecks when we can get them.
Yes, we do.
But nevertheless, that also rolls into the inflation number, and that's basically what keeps inflation supported, if not going higher, is that the cost of doing business is going up. Now, again, is that a bad thing? Maybe not, because maybe we do need to have higher business costs and shake out some of the weak businesses from the market and just make things a bit more stable in that regards. And net that does actually impact into oil demand and travel plans, because a lot of people, when they buy their airline tickets, they buy them on a credit card. You have to use a credit card to buy most of your airline tickets these days. You can't just go and walk up with a bunch of cash, pay for an airline ticket anymore, like you used to be able to do back in the 1980s.
Good old days. The
Yeah.
good old days.
So now, and with credit card interest rates going up along with everything else, it does impact people's travels decisions, because now instead of having a 2% APR, they're now 12, 15% APRs, 25% APRs in some cases. And so when you start getting those interest rates higher on your own personal spending cards, it does change your consumption habits. And that's probably one of the knock-on effects that's actually impacting global demand in general, is the fact that the credit, it's a credit crunch at this point.
Right, you said it. I can't believe you said it. You used the dreaded credit crunch term.
Hey, I'm throwing it in there, man.
Wow. No, look, I mean, it's look, again, I insert this caveat. It's very much, I'm in the process of getting a mortgage right now and buying a house. As an end user, is my thought process, oh shit, prices are high and interest rates are high, I think I'll wait. No, it's not, because I think people's agenda has changed. People have gone, I want security. I want to make sure that I can stay insular, I can keep my job and maintain a lifestyle. I think that people are willing to sort of knuckle down. And I don't believe that getting people to change their mind by raising borrowing costs is the way to do it. I just think it's flawed.
Well, it's not flawed. It's just that's the knock-on effect of increasing interest rates, is that it does change people's buying habits.
Of course it does, but I don't see that it is. I don't see it's working. Inflation at 5%, it's a lot lower than it was, but I don't know. Look, I don't want to argue with you about Jerome Powell. He can do one. The knob anyway.
Well,
we'll get him on the podcast soon.
Oh, there we go. Yeah, we should have him as a guest speaker, but not to keep everything U.S. centric, unfortunately. But it is a lot more U.S. centric, I think. Today, we're trying to doing the bookends. We talked a bit about China. Now we can go focus on the United States, because the United States is a right mess when you got the debt ceiling chat going on. And what are the knock-on effects that's going to have with the U.S. economy, and then net what that's going to do to financial markets as well. But the interesting matter is, the one story that keeps popping up that U.S. centric is the SPR, Strategic Petroleum Reserve, which used to be around 700 million barrels. It's now down close to 400 million barrels, if I've got my numbers right. And the continual talk of when is that going to get refilled? Story out yesterday was that the federal government was looking for the right price to refill the SPR. The DOE, but they have maintenance going on around the caverns, so they can't really do it yet. And I think the market, rallied on this story about the DOE looking to potentially refill the SPR in Q4 of this year. And it was a substantial rally in the markets on that headline. But nevertheless, I think the SPR is one of these things that I think people are over betting that the U.S. government will actually execute on this plan. Part of that is the fact that the Congress of the United States has actually launched an investigation into the Biden administration's use of the SPR, rightfully, wrongfully, but they're doing it because they think that the rapid depletion of the SPR stocks that was done during the war of Ukraine to help cushion the blow of the energy costs of the world damaged the SPR and did something that was well ahead of what the plan was with the U.S. Congress. So it'll be interesting how this all plays out. But I think, in my estimations, the SPR probably won't get touched until after the next election cycle.
Look, I mean, I was always, when that story came out, months ago or last year, whenever it was, about the SPR, I never thought that was a story that would cause prices to decrease. If you're an oil trader, the glass is always half full. So they always had to refill that SPR. And do they go on a buying spree? I don't think they do, but I think it needs to be managed carefully. I think they're probably better off talking to an Exxon or someone, whoever it might be, and get them to do it on their behalf, which I'm sure they probably will. But the market jumped on it. And that just goes to tell you how quick the market jumps on bullish news.
Yeah, but it's still a case that, when you think of the SPR had a drawdown plan to actually reduce it to this level by 2030. It was part of the Budget Reconciliation Act to reduce the amount of money being used in oil, bring it down to a more manageable level because the US production levels are so much higher than they used to be.
Mm.
Therefore, you don't need to hold the large amount of inventory because you're producing oil out of the ground. So there's a lot of things around filling the SPR. It's like, well, why were you going to fill it when you had a plan to deplete it anyway, 2030? Are you just going to refill it just to deplete it again?
Yeah.
So it's a bit of a strange one but nevertheless, I can't see it actually being actioned on because in next year you start the election cycle. And if Biden or if the U.S. government did something to increase gasoline prices for whatever reason, say they say, yeah, we're going to buy 100 million barrels of oil now, markets rally $10, and gasoline goes up with it.
Yeah.
And then the voters like, wait a minute, what are we doing? Why did you?
Yeah. Well, that's the balance they have to strike, isn't it?
Yeah.
Yeah, I think, like I said, I think it needs to be managed very carefully. I'm not sure Biden's energy secretary quite knows how much oil the US produces or how much it consumes, so we'll have to see. Just moving on 1 second, how is all things freight and shipping?
So tanker rates
Weaker.
have taken it on the chin. I mean, they're still good. They've come off from the highs, which can be expected, especially with OPEC reducing, potentially reducing the amount of production out or amount of exports out of the Middle East. So the tanker rates have come off. You also have had a shift of some ships that were in the dark trade of Russian flow, finding out, okay, that flow has been fully satisfied and I can't really get more business and the prices, that premium is coming down as well. I might as well go back to the normal market and see if I can get back into normal trade flows again. So you do have that double kind of impact on freight rates. So they've come off from their highs, but they're still good. Bulk freight is doing okay. Longer haul better than short haul. And containers are still dreadful at this point in time. You still don't have
Dreadful.
you don't have that end consumer demand yet to pull boxes across the ocean.
Well, I don't know. I'm looking at it now and I'm thinking, was that just a sort of aberration that caused containers to spike so aggressively last year? And obviously COVID, because of a lack of manpower, etc. So ships just weren't available. Is container freight about where it should be?
Well, the spike that did happen over the last 2 years was a supply driven issue because you had basically coming out of COVID, things were in the wrong positions to make the trade flow happen. And so you did have to rejigger the entire container box boat market to get boxes where they needed to be to get loaded, get put on a ship, and then ship those boxes to the ports where they needed to go and get them passed through the system. So from a pre-COVID price level, container rates are back to that place. And the container market, unfortunately, is suffering from a massive overcapacity, which it was suffering from back in 2018, 2019 anyway.
Yeah.
Now, but you do couple that with the lower manufacturing PMI readings that you have around the world. So it does show you that there is no consumer demand for consumer manufactured goods yet. Therefore, the PMIs aren't that high. Therefore, there's no drive to push for more container movements to support that market. We all see where the service levels are. The service levels are much higher. So until people are focusing their money not on buying a TV, but maybe going out to eat, maybe going to a movie, maybe going to the latest theme park that's nearby their house. And so they're going to spend more money on that versus buying the next Nintendo.
Yeah. Well, I've just bought a new TV. Just saying. See, I'm doing my bit for the economy. No, it's just we've seen we had our freight analyst Matt Wright. He's written a very good article this week on VLCC rates face a summer of discontent. I won't send it to you, seeing as you're in the VLCC business. But yeah, I mean, look, it's anyone I'm talking to in the shipping business just seems to be, it's like the Hamburglar, like just sort of getting around their business and sneaking about and just hoping that things carry on as they are because it's been very good, but kind of waiting for it to come to an end and readjusting. Is that fair?
Well, I think there's a lot of things impacting shipping markets right now. You've got the hope that China's demand does come out will drive shipping rates forward, but as that light of hope continues to diminish, people have to think about, okay, are we actually going to see the big recovery in demand that everybody's hoping for? Are we going to get to 2 million barrels a day of incremental demand or not? So that's a big question right there for the tanker market. You couple that with the upcoming EU ETS, the upcoming decarbonization moves that are going on. And so it does cause people in the shipping industry to think more and more about, well, I've got this old ship. Do I scrap that old ship and hopefully be able to buy a new ship that's going to run on methanol or ammonia or something else? Or do I try to squeeze as much life out of this old ship as I can and wait for the right technology to pop up?
I mean, again, that's something. Yeah, something that I asked, a few people in the business. What a lot of the new builds. What are they burning for bunkers? To get around, and everyone seems to be scrubbers. Everyone seems to have scrubbers to burn a high sulfur.
Scrubbers are the big thing to buy because you're buying a fuel that's $100 cheaper than VLSFO, which is your other alternative.
Yeah,
and therefore running a scrubber makes a lot of sense. So yeah, I think all new builds coming out of the yard are mostly scrubber fitted. I think the ratio is like 85% to 90% of all new builds. There's still people who don't want to do scrubbers, that's their choice from an economic standpoint.
Mm-hmm.
Less, and to be honest, when you put a scrubber, it's far cheaper than doing a retrofit.
So where's High Five now?
109 and Singapore.
High Five, sorry, listeners. High Five is the diff between VLSFO, very low sulfur fuel oil, and high sulfur fuel oil. So the 3.5% sulfur, as it used to be before the new rules came in from the International Maritime Organization on 1st of January 2020, and now if you burn that fuel, you have to use a scrubber which extracts the sulfur.
It washes
from the stack of the engine. Yeah,
washes the emissions. And so you have $109 in Singapore and 85 in Rotterdam.
So it makes sense then on a long-term basis. If a scrubber repays itself in 2 years?
At those levels, roughly, yes. Well, actually, it's cheaper than that because when you're looking at it from a new build versus a retrofit, it's basically 1/4 the cost of a retrofit. So in some of the new builds, you're seeing values around $600,000 to $800,000, which pays back a scrubber in 6 months.
Yeah, because I mean, just keeping it within the Middle East, Khor-Fakkan, which is one of the the main bunkering hubs within the Middle East. You've got Fujairah is obviously number one, but Khor-Fakkan's about 12 miles north of Fujairah. Business is booming there, and that's really where all the high sulfur business is carried out.
Well, I think that's something that's going to be a bit of demand that's going to keep growing as time goes on, and we'll probably see more support for high sulfur fuel in the future. I mean, I wouldn't be surprised if we see high five, that spread between high sulfur and VLSFO get back towards $60-$50. Because the ships shift from VLSFO into high sulfur fuel, that demand profile will change. That will also impact pricing going forward.
Yeah.
But I think that's about all we have for today.
It's about all my poor old throat can handle.
You get your voice, because you're not going to be singing any opera here anytime soon.
No, I'll be back next week with my soprano. Not Tony Soprano, but no, I will go and gargle some salt water. And yeah, look, it's been good to chat. It's one of those weeks where it's all a bit sort of, everyone's hungover because of the coronation. God save the king.
Yes, God save the king indeed. And on that bombshell, we all bid you a fond adieu from this point forward. Click like, subscribe, not surprise,
Yes, do that. And comment.
and
Yeah.
comment as you see fit. We look forward to speaking to you all next week. Stay safe. Bye for now.
Thanks.